something happened last week. Wayfair, the big online furniture retailer, reported exactly the kind of results we've been seeing from them for years. Higher than expected sales, powered by a terrific growth rate, but paired with weaker than expected earnings. No one ever seemed to mind that Wayfair was a long way from profitability. They only cared about the revenue growth, because this was a classic momentum stock. But this time around, something changed. Suddenly, investors ran out of patience. When they reported the latest numbers last Thursday, the stock lost nearly 20% of its value. And it's now down 50% from its highs in March. I think the story is finally unraveling, mostly because growth has gone out of style on the Wall Street fashion show. Nobody's willing to give Wayfair the benefit of the doubt anymore if they're going to keep losing a lot of money. So let me explain what's happening here, because you need to know the sea change. Ever since Wayfair came public in 2014, the story's always been about one thing and one thing only: growth at all costs. While the company's revenue growth has exploded higher, so have its operating expenses. That's how Wayfair goes from doing $1.3 billion in sales in 2014 to nearly $6.8 billion in sales last year. But its earnings per share shrink from negative $2.97 to negative $5.63 over the same period. The company had a 50% plus compound annual revenue growth, but in many cases, its operating expenses have grown even faster than that. For example, last year, Wayfair's sales growth accelerated to 43.6% year over year. That's up under 40% in 2017. But they made that happen with a big marketing push that caused their operating expense to increase by 52%. In other words, they paid through the nose for that revenue growth. Meanwhile, the company's been borrowing money in order to finance its growth initiatives. After boasting a clean balance sheet for years, Wayfair added nearly $1.5 billion in debt over the course of 2017 and 2018. And that's not terrible for an $8 billion company, but it does add a new wrinkle to the story: interest expense. Put it all together, and Wayfair's been developing some hideous earnings numbers for years. And they look even worse when you factor in the cost of stock-based compensation, because the company's constantly creating new shares to pay its employees. There's nothing new about this, though. For the last 8 quarters, Wayfair's reported better than expected sales, and with one exception, they've also delivered weaker than expected earnings. 8 quarters. All right, the one exception, when the company reported in late February, the earnings were stronger than anticipated, stock exploded higher. Maybe investors thought Wayfair had finally figured out how to achieve something closer to profitable growth, and that's why the stock hit an all-time high of $173 a few weeks later. Right around this time, RH, the company formerly known as Restoration Hardware, reported a disappointing quarter. The stock got hammered. On the conference call, their terrific CEO, Gary Friedman, voiced some outright frustration that Wayfair was getting such a high price-to-sales multiple when the company's not even trying to turn a profit. In response, I told you to ignore Wayfair and buy RH, because I'd rather own a stock with profitable growth than one that's burning money simply to impress Wall Street. Since then, what's happened? RH has rallied 71%. Wayfair stock is down more than 40%. Friedman was confident that both stocks would eventually get their due. And it looks like he was right. Thank you, Gary, for teaching us what works and what doesn't. So why did the market finally turn on Wayfair? For starters, the company encountered a bunch of headwinds, like the trade war with China. As a furniture retailer that competes on price, Wayfair sources a lot of its merchandise from China. Listen to the snippet from the latest conference call. Since the beginning of the year, more than 90% of our suppliers who are subject to China tariffs have raised wholesale prices, which have resulted in higher retail prices. As retail prices on the site fluctuate, we observe that our customers' consideration cycle gets disrupted and is effectively lengthened, end quote. Ouch. Wayfair also had some key executives leave. In July, the company told us that both their chief operating officer and their chief technology officer would be retiring. At the time, the stock sold off hard, but most of the analysts who followed it claimed it was a buying opportunity. Well, you know what? They were wrong as the stocks continued to come down. More importantly, Wayfair's growth seems to be slowing. Remember how last year their sales growth reaccelerated to 43%? Well, this year it's decelerated again, falling to 38% in the first quarter, 41% in the second quarter, just 35% in the third quarter. Now, it's tough to be a growth stock when your growth is slowing, albeit from a high rate. Meanwhile, when you look at Wayfair's year-to-date income statement, you get that sense that they've really run out of options to keep boosting their growth. Company's already raised its capital spending to improve the platform. They've increased their ad spending. What more can they do? While their sales are up 38% for the year, their operating expenses are up 52%. Again, it feels like they're spending more and more to buy less and less growth. Wow. Bad combo. Most importantly, though, by the time Wayfair reported the same kind of quarter we've gotten used to from last week, Wall Street's attitude toward growth stocks had changed and changed dramatically. We've seen a massive rotation out of growth and into value stocks with proven earnings. It's taken down the deserving and the undeserving alike. Well, how about Grubhub? How about Align Technology? They've been savage because money-losing competitors are eating into their market share. They had it coming, but the cloud stocks have been hit too. After a parade of unprofitable IPOs this year, investors have really run out of patience for this kind of business model. They're no longer willing to pay up for something like Wayfair with fast revenue growth but no apparent path to profitability. And that has been terrible for the stock. And even though Wayfair stock is now down 50% from its highs, it's not clear what they can do to turn things around. They need to do a wholesale revaluation of their strategy, and I'm not sure they can pull that off. The bottom line, Wayfair imploded last week because this market is sick and tired of companies with rapid revenue growth that are losing massive amounts of money. Throw in the fact that Wayfair's been hurt by the tariffs and their growth is slowing, and you can understand why the stock was eviscerated. This has become a momentum stock without any momentum, which is why I think you need to stay the heck away from it. As long as growth is out of style in the Wall Street fashion show, Wayfair stock, it's going to be toxic. Let's speak to Greg in Texas. Greg.
Yes, sir.
Hey.
I'm in the house of pain big time after Pendereth's 20% beatdown last week.
Yes.
What's your long-term guidance on that stock?
Okay, here's the issue with Pinterest. They told you they were going to do X. A lot of people feel like, hey, when they say it's going to be X, it's X plus 2. No, they did X. I think that Pinterest is a real company. It's going to do well, but it's not going to grow as fast as you'd like. And it's going to spend some time in the penalty box. But these are smart guys, and they are figuring it out, and they are doing well. I would not abandon Pinterest down here. Let's go to Andrew in Ohio. Andrew.
Hey, Jim. I dig your show, man. Thanks for all your awesome advice.
Of course.
So I picked up Shopify in its 320s back in July here, so I've seen it go all the way up and all the way down and then some. So am I kind of going to expect it to keep going down, or what are you going to? What do you see?
No, I mean,
next
I was
year
looking at it we have a club call next week for action alerts for my club. And I'm thinking, we sold this thing much, much higher. I really think if you can get this thing below 300, I say you. Buy. So I'm not going to worry about Shopify. That's a very smart company. All right, growth, hyper growth, is out of style in the Wall Street fashion show right now. That, along with a lot of other factors, now you understand why the stock of Wayfair has just been eviscerated. I need you to stay away from it. All right, much more Mad Money. I'm talking to one company leading the charge on the digitization trend. Don't miss my sit-down with the CEO of J2 Global, the opposite of Wayfair. Then I've got the exclusive with a private company that's hoping to change the way you travel and could be rolling into a city near you. And all your calls are rapid fire in tonight's edition of the Lightning Round. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.